Hello my dear students, today we are going to do the chapter ratios. We begin with the ratios called as solvency ratios. Okay, so the first solvency ratio is debt to equity ratio. So what do we know from debt? What do you mean by debt? Debt is any amount of money that you take and you owe it back to that person or institution or whatever it be. So we have our debt to equity ratio. Now if you see, I have written debt as outsiders fund and I have written equity as shareholders fund. So outsiders fund means what? The amount of money that you raise as capital from outside the firm, or not from your business but from outsiders. It can be a bank or any other financial institution. Okay, and what do you mean by shareholders fund? Shareholders fund means the amount of capital that is provided by the shareholders, or who are shareholders? The owners of the company. So this ratio will tell us how much of outsiders fund we are using and to how much of shareholders fund we are using. Okay, and one another specific thing that you need to take into consideration is we take into consideration only long term debt. Okay, that is why I have written in brackets long term debt. So long term outsiders funds divided by our shareholders equity or shareholders fund. What is shareholders fund? It is also known as equity. It includes our equity share capital, our preference share capital, our general reserves, our accumulated profits, and all the amount of money that belongs to the company that is provided by the shareholders, or the amount of money that is made by the business itself, not any amount of money that you borrow from outside. Whatever you borrow from outside goes under outsiders fund. So that is the first ratio, and the ideal ratio for it is 2:1. Any ratio higher than this is bad. It is bad. Why? Because it shows that the company has more of outsiders fund. More of outsiders fund means more of risk that we have to pay back the debt, and it will also affect the financial standing, long-term standing of the firm. Therefore, a ratio higher than this is considered risky for the business. Okay. Next, we move on to the profitability ratios. So, the profitability ratio, definitely as the word goes, it shows we calculate ratios on the profits of the firm. Okay. So, the first ratio under that is our gross profit ratio, and the gross profit ratio is gross profit by net sales into 100. So, whatever is the gross profit, what is gross profit? Sales. Gross profit is sales minus our cost of sales is gross profit. So, what is the gross profit? That divided by our net sales. Net sales means sales minus sales return or anything like that. Okay, our net sales will give into 100 will give us the gross profit ratio. In the same way, our net profit ratio. Net profit ratio is our net profit by net sales into 100. Now, what is net profit? From our gross profit, when we minus our other expenses and add our other incomes, we get something called as operating profit. From that, when we deduct our interest and tax, we come to our net profit. So basically, our gross profit minus other expenses and income will give us our net profit. That net profit into our net sales into 100 will give us our net profit ratio. I hope the ratios are clear, our solvency ratio and profitability ratios. Now, we will go on to a question relating to debt and equity. So, as you see, first we have the equity share capital, we have the general reserve, we have debentures, we have sundry trade creditors, and we have preference shares. So, now we need to find our debt to equity ratio. So, in this, what all includes debt? We have debt means only long term debt. We don't take short term debt, we take long term debt only, and that is why we only include debentures and we don't include trade creditors. Trade creditors are also a debt or are also a liability, but they are known as short term liabilities. So, we only take debentures 75,000. Then we have equity. What all includes equity? Our equity share capital, of course, our general reserve as I told you, and our preference share capital. Okay, I will be sending the bifurcation of each of these via your notes. So just understand for now that our debt will only include our long term debt, and our equity are equity share capital in this question, general reserve and preference share. Add it and divide 75,000 by 1,75,000. The ratio will come to 3:7. I hope you all are clear with this. Thank you.